Oh my God, that's good. Right. Good morning, everybody, and welcome to this PD Tax webinar on succession planning. And it's succession planning with a particular angle on succession planning in relation to families, not management teams, so to speak. And today we've got myself, Paul Davison, and my learned colleague, Laura Brennan, who will be talking to you about this topic. What do PD Tax do? Well, we provide tax advice for business owners primarily, but we also do it for individuals and trusts and estates. We do some compliance, mainly sort of more complicated tax return forms for individuals or trusts or estates. And we do help other professionals in the region, and in fact nationally, on tax issues for their clients or for themselves. We also do valuations of private limited companies, but it doesn't say it on there, but we do. Right, housekeeping. So today's webinar, it does finish at 10 o'clock. Sorry if you thought it started at 9, that was incorrect. It starts at 9:30, finishes at 10. Your mics will be disabled throughout, so you can shout as loudly at the screen as you like, but we won't hear you. But please submit your questions via the question and answer box, and Laura is going to ask those questions at the end, pose those questions to me and herself. But if your question isn't answered, don't worry, because we'll contact you following the meeting. We actually don't have a breakout session today because we just don't. But this presentation is for general information only, and is not intended to constitute individual specific advice. It is recommended that you seek competent professional advice before taking any action. Right, thank you very much for that introduction. I'm going to pass on now to Laura, who's going to start the interesting stuff. Laura.
Morning, everyone. So I'm going to be discussing succession planning for investment companies, and later on Paul's going to be discussing succession planning for trading companies. Paul, I don't know if I can move my slide. Okay, so in terms of succession planning for investment companies, we're going to be talking about growth shares and freezer shares. But before we get into that, it's quite useful to understand some of the issues that are faced with succession planning for investment companies. So investment company shares are subject to IHT, and they don't qualify for IHT reliefs such as business property relief. If shares in an investment company are gifted, a significant CGT liability can still arise on the donor, as this will be deemed to happen at market value, even if no consideration is received. But some people might still think that it would be better to face CGT at 20% rather than IHT at 40%, and so they might still gift their shares to their children. However, this would be a potentially exempt transfer, so if the donor died within 7 years of the date of the gift, IHT would also be charged, meaning they would have effectively suffered a 60% tax rate on the gift of investment company shares. Or could you change the slide, please? So growth shares are a really useful tool in overcoming these kind of issues for clients when succession planning for investment companies. So growth shares are a special class of share that allow family members to participate in the value of a company over and above a valuation hurdle. They allow the future value of the shares in the investment company to be transferred to family members free from CGT and IHT, and the value of the shares owned by the current shareholders is effectively frozen. So we often refer to these shares as freezer shares. So how do growth shares work? So the first step is for family members to acquire a class of share with special rights. So these rights typically have limited value unless and until a valuation hurdle is achieved. And once this happens, the rights attached into the growth shares effectively flower, and they are entitled to a share in the company's value beyond the hurdle. The shares acquired on the date of award, so it's not like a share option plan or like an EMI scheme. And growth shares are typically designed so that their initial value is relatively low, which makes the cost manageable for people to acquire them. So the intention behind implementing a growth share structure is to freeze the value of the shares belonging to the current shareholders. So these are usually owned by the older generations, and then issue shares to the children so that future growth in the value of the company accrues to the younger generations. So this is achieved by the company's shareholding structure being structured into a number of different share classes with differing rights. So typically the current shareholders will have shares which carry rights to dividends, votes and capital and winding up. The rights of these shares can be changed so that they effectively become freezer shares. So that means that their value is limited either to the current value of the company or a valuation hurdle which is to be met in the future. The growth shares, which were usually owned by the children, typically have no rights to vote and only right to future growth in the capital of the company after a valuation hurdle has been met. However, the rights attaching to freezer shares and growth shares are flexible. So for example, rights to income from the freezer shares could be made to taper away as the current shareholders get older, and the growth shares could acquire the rights to income in the future. So as you can see from the diagram, once the valuation hurdle has been achieved, the growth shares effectively flower, and that means the younger generations can receive the proceeds of sale above the hurdle point. So as I mentioned earlier, the rights of the growth shares and freezer shares are quite flexible, so it would be possible to taper the rights to dividends, so the growth shareholders could receive income from their shares. But up until the valuation hurdle has been met, the current shareholders will retain the value of the shares, including rights to dividends, capital, and votes. So in terms of inheritance tax, growth shares can be good as all future growth in the business value is allocated to the growth shareholders. It means that all growth above the hurdle would be outside of the freezer shareholders' estate, which is particularly useful for investment company shares as these do not qualify for business property relief. Where growth shares are implemented, the existing shareholders would technically be making a disposal of their right to participate in any future company growth to the growth shareholders, and that's for both IHT and CGT purposes. Although when the growth shares are issued, they typically have little to no value, but HMRC have recently been considering the hope value of those shares where the company value is likely to increase in the future. So a valuation exercise should be carried out by a professional before the growth shares are used. But this is something that we're able to do by using the Black-Scholes model for valuations, and this model basically puts a value on the chance of a future event happening. So in this case, it would be the chance of the valuation hurdle being met and the growth shares having a value in the future. So it's time for a poll. So do you think that the growth and freezer shares are an efficient way of managing clients' CGT and IHT exposure when passing investment company shares down to younger generations? Okay, so most people have voted for very effective and some aren't sure. So if you've got any questions about them, just put them into the question box.
Thank you, Laura, for that talk on freezer and growth shares for investment companies. So that's the way that we're dealing these days with succession planning for investment companies. We're now going to talk about how we deal with trading companies when it comes to succession planning. And again, this is just for family members, not for management buyouts. So Laura talked in depth there about growth and freezer shares. And actually, when it comes to trading companies, these are not required because key differential is that trading companies qualify from PPR from IHT. So anybody who has a trading company in their estate at death, the shares in that trading company are not subject to inheritance tax. Oops. So if that's the case, why would you transfer shares to younger generations? Well, the main reason really is to ensure business continuity, because as people get older, they lose the energy, they lose the powers of determination to move the business forward. And if the trading stalls and trading no longer happens and the business becomes unsuccessful, then by definition, the business fails and we lose inheritance tax relief. So whilst it's obviously good to keep the shares in your estate until you die, it's a double-edged sword and often could backfire. So what are the options in terms of moving shares in a trading company down the generations? Well, the first option is a pure gift. Quite simple. A gift of shares in a trading company is free from stamp duty. And we can also avoid capital gains tax on gifting shares down the generations by using section 165 of the Capital Gains Tax Act, which is a capital gains tax relief for trading assets. We can to get that relief, we do need to make sure that the company is a proper trading company and there's no material investments in that company. If there's material investments in it, it may not be deemed to be a trading company and you won't get the relief. When you make the gift of the shares, tends to be via a stock transfer form, you also need to make sure that you do sign a section 165 joint election, because the election needs to be made by the donor and the recipient. Because if you leave it till after the gift has been made, the recipient might say, oh, I don't want to sign that election. And then you end up with a nice big capital gains tax bill. It's also very relevant to note that relatives on receiving shares in a trading company won't pay income tax, like an employee might, because there's a specific get out in the tax rules that says that income tax is not payable if a person receives the shares in relation to their family relationships. So gifting shares in a trading company is relatively straightforward and simple. Oh, yes, sorry, I didn't mention IHT yet. So IHT, it will be subject, it'll be free from IHT for at least, as long as a person who's gifting a share survives 7 years, it's free from IHT for making the gift. It could also be free from IHT sooner than that, because potentially BPR will rely on the gift as long as the recipient of the shares continues to use that company as a trading company. As I say, gifting shares is quite simple. But the second option, which is a little bit more complicated, but is also very worth thinking about, is using a new company route. New company routes can be used for all different types of things. And we know that these days, getting money out of a company is difficult. Normal dividends payable at sort of 40% if you're a higher rate taxpayer, etc. So getting money out of a company is difficult. And if you get the opportunity to get money out at 10% or 20%, then that's got to be worth thinking about. And we know that any change of ownership is an event where we can try and get money out of a company at 10 or 20%. And the change of ownership doesn't have to be to a staff member, it could be to a family member. Now, we do need to get clearance for this from HMRC to deem it to be commercial purposes and not the avoidance of tax. And it's going to be easy to get clearance if the people given the shares to do work in the business, which is often the case. Often the case, we do have children working in family businesses. Sometimes, obviously, there's some children that don't work in the family businesses, and I think if they got shares as well as the people who do work in it, you would probably still get clearance, but every case is different and needs to be looked at in terms of whether you're going to get clearance or not. And the way it works is that basically the children, however many there are, 1, 2, 3, 4, set up a new company. They decide themselves to what sort of share percentages they're going to have in the company, or the family decide between, you know, as a general chat, who's going to have the highest percentages. And they acquire the shares from the parents. The new company acquires the shares from the parents, and the new company effectively owes the parents the money. This was stamp duty payable on the acquisition by Newco at 0.5%. So we know then that the loan notes are owed to the parents. And what we can do is we can actually pay money up from the trading company to the Newco, free from tax, to pay off the debt. So once the companies receive the money, we can pay off that debt drip by drip. We don't have to pay it all at once. We can pay it over a period. The parents might not need all the money, so we just decide we can pay it up whenever family agree. What else could we do? Well, those loan notes that we've got could be gifted to the children by the parents. It's an option. If the parents don't need all that money, they could then gift a loan note to the kids, to the kids' trading company, and then owes them a load of money. And as long as the parents survive 7 years, there's no inheritance tax. So you can see there what we've done is we've arranged for the children to get the loan out of the trading company that they now own at 10 or 20%, which is these days is exceptionally good. Some other things we could think about is that before we do the Newco route, we could put some of those shares that the parents own into a trust. If we felt that trust planning was something we wanted to look at, because we wanted to protect future generations and get stuff into trust. If we put stuff into a trust where when we qualify for BPR, we can get more into the trust than just the normal nil rate bands. So if we're talking big numbers, it's always worth discussing involving a trust before we do the deal, just to make sure that that's something we've thought about in terms of the long-term planning for the future. Succession planning for families can't be achieved by EMI schemes, as the family members can't gain options. So just some of the sort of ways of getting money out of a company on succession and people finishing working for the business. Could a director who's working for the business, the parent, could they resign from their directorship and gain tax efficient termination payment? We know 30 grand can be paid tax free and tax and national insurance free for the termination of an office. In terms of the facts, how much they've been paid, how long they've been paid that money, is the £30,000 termination payment warranted? Any other ways that a departing shareholder could gain income following the Newco route? Well, they could retain a nominal shareholding, say 5%, and then receive dividends on that. That doesn't seem quite as common as it used to. I think they just want to I think the kids just sort of want to take control, or the parents just want to say, get on with it. So that's not quite as common as it used to be, but another way to do it, company could pay interest on the loan notes that they receive for the Newco route. Interest is, at the moment, is probably the most efficient way of getting money out of the company, because we don't get national insurance charges and we get tax relief on the payment of interest. So interest is a really good way of getting money out of the company at the moment. Also, if they do provide some sort of consultancy services to the company, they've got a lot of experience in that company, that business. They might be required every so often to sort of duck in and out to provide some knowledge. Can we pay them a consultancy fee? Right. That was like the end of the technical stuff, Laura. Are there any questions that have been asked by our lovely delegates today?
Yeah, we have one. So if using trusts for shares, can multiple trusts be used?
It's a good question. I think the answer is yes, it can. But I think you've got to decide on why you want multiple trusts. The multiple trusts could be used for like different beneficiaries, for example. I don't think there used to be something where you get the different timings of trusts, money was into trusts, and there used to be an advantage on having different trusts to get the timings. I don't think that still applies. So I think you can use multiple trusts, and I suppose you would decide on who the beneficiaries are of that trust and how many shares went into each trust, and what the purpose of each trust was for going forward. So you might have, for example, you might have 2 children in a family, so you do one trust for that family, and the issue of their family. You do another trust for the other part of the family and the issue of that family. So you got like 2 streams of trusts going down the line. So the answer is yes. You just got to look at the situation to decide why you would want to have more than one trust, I suppose.
And the next question was, when would voting power be passed to the children with grey shares? So I can answer that one. So you'd need to decide when the grey shares are granted, because that's when we would do an evaluation exercise, and we'd be evaluating obviously the change of voting rights and the passing of rights from the freezer shareholders to the grey shareholders to determine whether there'd be any tax liability on that. So you would need to decide when the grey shares are set up.
Yeah, that's right. I think the other things you can think about are whether some of the freezer shares can be gifted to the children post the restructuring. So, for example, what you could do, the freezer shares could be restructured themselves. So we sort of take the votes out of the main class and put them into a separate class of shares which are held by the parents. And then, for example, you could gift those shares with votes, you could gift those into a trust, for example. And the reason you do that is gifted to a trust means that if you remain as trustee of that trust, you can still control the votes, which means you control the company. But you set in a 7-year clock ticking on inheritance tax by gifting the votes into the trust. As long as the value of the votes is less than the nil rate band, £325,000, then there's no tax payable on gifting those votes into the trust, because you can also get CGT relief on a gift. So yeah, you don't want to keep the votes through the main restructuring, but after you've done the freezer and growth share setup, you can consider whether we move votes down the line post restructuring. Anyone want more, I think?
Yeah. So if a client did a NewCo route but deferred some consideration, would it be taxable upfront?
No, that's a good question. I think it depends on the there's 2 things to think about here. The first thing is, does it qualify for business as a taper relief, the disposal? And the second thing is, can we use some sort of loan note mechanism to defer the tax? Because obviously, if you get a loan, if you sell for a loan, then by definition you don't have the cash. You don't have the cash to pay the tax. So you want to make sure that you're in a position where you can pay the tax. So that's an arrangement to be had with the kids in terms of making sure they've got that tax. But in terms of if they had the money and the money was readily available, And I think what you would try and do is probably you would try and make sure that you bank business asset table relief, which effectively means you might have to pay the tax on that part of the consideration up front, which could be up to £2 million if it's husband and wife owning the company. But anything above the 2 million, that first £2 million consideration, you're not trying to qualify for entrepreneurs relief, business asset table relief, it is now. So you could set the balance up as loan notes, which means that the gain on those loan notes is only going to qualify. It's only going to crystallise for tax once that money is received. So the question is, it's another area that needs a bit of thought, but generally speaking, we can be sensible and not pay tax generally until we get the money. Any other questions, Laura? Is it time for these good people to go on their way today?
I think we have a couple more, but we could always get back to you later on.
We've got 2 more minutes.
Okay. So if section 165 is being considered, if a company does have accepted assets such as cash, which are excessive for the business, but not over 50% of value, is section 165 allowed on a proportion of the value, or is it all or nothing?
Ooh, a long question. It's all or nothing is the answer. It's either a trading company or it's not a trading company. And the tests are similar to the tests for business asset table relief. It's the 20% test, it's the test. Accepted assets is actually not a principle of capital gains tax. Accepted assets, accepted EXCE, accepted assets, is not a, it's a principle of business property relief and not capital gains tax. But they did that question. The questioner did mention cash. We can talk about cash. I think it's quite well understood and agreed by people and by HMRC that cash, which is sat in the business, but it's not an investment, it's just sat in the deposit account or sat in the current account. Even though it might be excessive in terms of working capital, it's not deemed to be an investment. And for dilution of trading status to occur, there has to be an investment asset, a material investment activity. And because cash is not deemed to be an investment activity, it's deemed to be sort of a nothing. And cash, generally speaking, shouldn't affect the 165 claim. Obviously, the higher the cash gets, the more nervous you get. But we know you can apply to HMRC for a free transaction clearance on business asset table relief, which would be the same test for 165 relief. So you could do a pre-transaction clearance for this to make sure that you're happy with it before you went ahead. That makes sense. Okay, well, thanks very much. It's now 10 o'clock. It's time to go on your way. Have a very successful day, and don't forget that tax is tricky. Tax advice. That's supposed to say take advice, but it does say tax advice. So take advice in tax. Thanks very much, and have a nice day.